Hello, everyone. We're going to be solving problem on double declining balance. We have this problem here. We're purchasing equipment for 900,000 on January 1st, 2020. So we don't have to worry about buying equipment in the middle of the year. So this is for an entire year that we're going to need to depreciate. So we're going to be doing double declining. For double declining, that means that we're going to have to double the rate that we would normally use for a straight line. Okay, so if the estimated life of the equipment is 3 years, when we do straight line, we would do 1/3 per year, right? Oops, let's change this, 1/3 per year, right? So we can do it in percentages, 1 divided by 3, okay? It's 0.333. So we're gonna multiply that times 2, and we're gonna get, let's write it nicely here, we're gonna get 0.333 times 2, 66.67% per year. Okay, so double declining, we're going to start with the book value. We're going to have a book value. And then we're going to multiply times the percentage, okay, which we have here. That was going to give us the expense amount. Okay, so depreciation expense. Okay, so the book value is 900,000. Okay, when we buy it the first year, so we can move this, let's say year 1, year 2, year 3. Let's move it over here. Okay. Year 1, the rate that we're going to use is a double rate, double the straight line. Okay, double straight line. That's why it's called double declining. So the depreciation expense for year 1 is going to be 600,000. But before we continue, let's not forget that we have a salvage value. Notice how I'm not using the salvage value, okay, when we start, because salvage value has nothing to do with book value, okay? Salvage value will tell us what is the maximum amount that we get to depreciate. So let's do it down here, okay? So historical cost minus salvage value will give us the depreciable amount. Okay, so historical cost, 900,000. The salvage value, we're going to subtract 40,000. That means that we can only depreciate up to 860,000. So we can never depreciate more than 860 because we're assuming that we're going to be selling this path for 40,000 at the end of the 3 years. So the 40,000 that we're going to get back is not depreciable. We can only depreciate up to 860. So first year, we're going to depreciate 600,000. Year 2, now we have a new book value. Okay, the book value will be whatever we paid minus what we have already depreciated. Okay, now we have a book value of 300,000. So we're going to apply the same percentage. Okay, we compute it up here. So that's going to tell us how much we're going to depreciate in year number 2. 200,000. Okay, so now we're going to have, we can write accumulated here. Accumulated depreciation. Okay, 600,000 year 1. Now we have 800,000 because we're adding the 2 years, right? So we can only depreciate 60,000. We cannot depreciate more than 60,000 because we can't go any higher than 160. And so far we're at 800. Okay, so year 2, year 3. Now we have a book value of historical cost minus accumulated depreciation. Our book value is 100,000. But it doesn't really matter what the percentage is here, okay? Because as the last year we're going to be using, we have to depreciate the balance, okay? Which is 60,000. That's it. Okay? The last year we don't go by the percentage, whatever remaining amount. So at the end of year 3, we're going to dispose of. We have to fully depreciate. Okay, so now the accumulated depreciation will be 800,000 plus 60, 860. right? And the book value at this point is the salvage value, okay? After year 3. All right, so the answer is B. All right.